They look at that 6% number and think, perfect, I'm just going to buy something high yield that is 6%. But yield is not always free money. Higher yield usually means higher risk when it comes to the ETF, lower growth, or potential capital erosion. When we start looking at some of these zero DTEs, when you start looking at yield max, when you start looking at the QQQI, have to make sure that you're covering this. And you also have to take into account, which most people do not. Inflation right now is 3%. Your portfolio isn't growing if you're not beating out that inflation, especially if you're planning on living on that 45K or taking dividends out of that portfolio. So essentially, you would be losing purchasing power. Income without growth is a very, very fragile thing that you don't really want to have. This is where mature portfolios design really matter. How we build this out. Dividend income is not always about maximizing yield. That is, again, where an ETF like the SCHD comes in. It is about a couple different things, including stability, inflation protection, sequence of returns, and how you're actually getting that money. And of course, the emotional stability that you can sleep at night. You don't need your portfolio to scream. You need it to endure.